Should you save or invest? This is a really, really good question. It's one I get all the time. And say you have a bank account with some cash in it. You know, how much is enough? How much to the point where you're like, okay, actually, I want to put some of that money into the market. Or on the flip side, you're already investing. Should you be holding on to more cash? Basically, for that next dollar that you make, does that go into savings or investing? I'm going to break that answer down for you guys today. Hey guys, Jessica here. Before jumping into it, really quick call out that we're Uprise. We're a fintech company that puts together personalized Wall Street level financial plans completely free. And this is a lot of what we do. Like, we take a look at people's situations. We've seen some people who have a lot of money investments and very little in cash. And on the flip side, a ton of money in bank accounts, but not enough investments. And so we can take a look at your specific situation, help you optimize that. To get your plan, definitely check us out. I've linked to us in the description below. And also, please make sure to give this video a thumbs up, hit that subscribe button. It really, really helps small channels like ours. Getting back to it, this is a really good question to be asking it, because if you're asking it in the first place, it means you're working towards building wealth, which is freaking amazing. That said, there are major, major differences between them. And so it's really important to get it right. And so the way I'm going to do this video is I'm going to talk first about the pros and cons between them so you guys get an understanding, and then help you figure out, okay, with that extra dollar, which one should I put it towards? Okay, let's jump into it. So really quickly, just to make sure everybody's on the same page. When I say saving, I mean taking your money and either holding it in cash or putting it with a bank in a savings account or a checking account, something like that. And then when I say investing, I mean going to, say, a Vanguard or Robinhood and buying stocks or ETFs or crypto or whatever other kind of investment there. And the main difference here is, you may have heard of this before, risk versus reward. So if you keep your money in a savings account, there's basically no risk. As long as you keep your balance below 250K, which is the current limit, all of your money is backed by the US government, by an agency called the FDIC. And even if this particular bank that you kept your money with goes under, the government is going to step in and make you whole. That said, because there's no risk, the reward is also pretty tiny. So most banks pay an interest rate, but it's usually some tiny, tiny percentage, like 0.1% or even lower. And so you're not getting a ton of money off of the balance that you're keeping with the bank. The highest that we've seen in the market right now is 3%, which sounds like decently high, but you have to jump through a gazillion hoops. It's a really painful process to get this bank account. If you want to hear more about that, you could definitely check out our video up here, where we did a review video about that bank. So that low reward part, that is the biggest con of saving. You may have heard of something called inflation. It basically means that prices around you are going up. And this is a phenomenon that's happening in the US and also in the entire world, actually. Gas prices are at the highest that they've ever been. Restaurants are increasing their prices. Rent is going up. And basically what's happening is that you're holding on to a dollar, but then it's buying less and less over time. And so the last I heard was that inflation has gone up by over 7%. Okay, so you're making at the max 3% here, or probably way, way less than that. And in the meantime, prices are going up by over 7%. Like, it doesn't, basically that dollar, over time, you are going to be able to buy less and less. The value of that dollar is going to be lower and lower over time. But that said, the returns from investing are a lot higher, especially over the long term. So for the last 100 years or so, the S&P 500 has returned on average 10% a year. All right, so that's out of the way. Here's how I recommend thinking about it. I recommend thinking about your money in buckets. So the first bucket is the emergency fund. This is money that you might need at any point in time. And so you want to keep it in a very, very low risk place, i.e. cash in a savings account or a checking account. And the reason is because, hey, you might need it for an emergency, for example, but it also comes in handy. Say, if you need a big lump sum of cash, like you're moving apartments, you need an extra month of rent for a deposit, something like that. We did a separate video about how to think about emergency funds. You normally need 3 to 6 months of monthly spend saved up in cash. And so you could definitely check out our video up here that talks a little bit more about that. After that, after the emergency fund, think about the kind of purchases, big purchases that you might be making in the next 2-ish years. So maybe you want to buy a car in the next 2 years, or you want to buy a house even. For any money that you want to put towards a big purchase like that in the very near term, then you also want to hold that in a very, very low risk place as well. Either a very low risk investment or even cash. And the reason is because you guys probably know this. The market goes up and down all the time. You don't want a scenario where like on the day that you want to buy the car, the market is like way, way down and you don't have enough money. And then that last bucket is pretty much for everything else. Money that you need in the medium term and beyond. And this is where you invest. I want to call out that even when you start thinking about investing, think about what you are investing for. Like, are you thinking about going to grad school in like 5 years, which is like medium term? Or are you thinking about retiring at the age of 50? Whatever it is, you should match your investments, the amount of risk of your investments up to the time frame where you might need that cash, right? Because say you need the money in 5 years, you don't have the luxury of having the highest risk investments versus if you need something in like 50 years, then yeah, you should go much more risky. There's a lot of complexity to investing, so I won't go too much into detail here, but I do want to call out 2 things. The first one is if your employer offers a 401k match, definitely take advantage of that. That is free money over a long period of time. And then the second thing is check out robo-advisors for investing. We are big fans. They are automated services, very low fee, that help you figure out like what to invest in. And they even like work backwards from goals to help you, as I mentioned, line up your risk and the reward profile to towards those goals. If you want some recommendations, I'll link in the description below to a few that we like. And also we did a review video about a robo-advisor, so you can definitely check that out as well. And that's it. If you have any other questions about saving versus investing, definitely let us know in the comments below. And also, if you'd like more support with your finances, definitely check us out. The link's in the description. We put together personalized Wall Street level financial plans completely and 100% for free. So if you have questions about this topic, about student loans, about budgeting, employer benefits, whatever it is, we'd be happy to help. And on average, we put 100K in net worth back into people's pockets. Other than that, if you got value out of this video, please give us a thumbs up, hit that subscribe button, and click the bell for notifications. See you guys next time.